and I'd say most banks have for
Peer Zoom is having a hiccup, so let's just be patient for a second.
Sorry about that. For some reason, it kicked me on out.
Yes,
Let me
guys, I have a professional version, as we all know and experience too often. It still has some hiccups, but yeah, why don't we pick it up where you were talking about?
Yep. And if you can give me the ability to share my screen so I can put the materials back on up there.
Do that. Let me give you that again. Okay, so you should have it.
Okay, perfect. So what I want to highlight are the two ways that we help our clients when it comes to making these international type of payments. So number one, we have a Treasury solution. This would be your standard wire type module. Some banks have this, a lot of regional banks do not. This allows you to log on, set up a template such that if you make, let's say, payments for employees or products, goods and services, you're able to actually go ahead, set up a wire template, and then make that payment more fully. You're able to lock in the exchange rate. You're able to send exactly how much currency you want. We sometimes have clients that try to send a dollar amount overseas. Unfortunately, whenever a dollar amount gets sent, it's converted at an unknown FX rate. So therefore, you have troubles trying to exactly hit the amount of currency that you may need. So with a Treasury type platform like this, which again, we'll go into more in depth, it really helps to do those more, call it lower value, higher volume, more nuisance cash management payments. On the other hand, we also at Texas Capital Bank have the ability to help with risk management. So this can be anything from education, so what we're doing here today, also cross-border M&A. With the strength of the dollar the last couple of years, we have seen a lot of clients look to put their capital work overseas, maybe expand their operations, maybe look at vertically integrating their business. So cross-border M&A is a significant risk because you may only have a certain amount of dollars to make an acquisition. But if the currency were to strengthen, if you want to buy a company in Europe and the euro strengthens, the same amount of dollars will actually mean you can buy less euros. So you might not be able to actually close your acquisition if the currency were to go against you. And then we'll also go in the back end of the presentation, the idea of hedging. That's the idea that if you have a machine that you need to buy 1 month, 2 months, 6 months from now, how do you lock in the exchange rate today such that you know exactly how many dollars it will take you to buy that foreign currency item? And then market insight, we send reports out to our clients. We provide them with updates. For example, as we've seen the peso over the last year or so, the super peso, as it's been sometimes called, we've been trying to get our clients, if they do have costs in Mexico, to look at hedging to lock in some of their costs because of how expensive it has gotten to purchase pesos down there. So these are, I would say, the two different typical ways a client would interact on the foreign currency front. Again, either a cash management wire system or something that's more strategic or bespoke that would work more bilaterally with someone like myself. So going on to the next slide, I want to have you, there are a lot of words in this slide, but what I want to focus on is this right side of the screen. So typically, whenever we have clients making payments overseas for maybe the first time or as they're getting used to it, they may only send currency, they may only send dollars. The problem with sending dollars overseas is those dollars are taken by that foreign currency provider, and then they're converted to a local currency. So if you have your supplier, and let's use China as the example, if they get dollars and then convert them at the prevalent market rate, they may not know how many Chinese renminbi they'll actually receive. So if you pay them in dollars, they may actually ask you to pay more dollars than what is to be expected to protect themselves against any sort of movement in the currency that can mean they get less currency in the back end. So what are ways to avoid that? Well, number one, you can ask your supplier for what's referred to as a dual currency invoice. That's asking your supplier to price out your contract in dollars, but also in local currency. This can go for pesos, Indian rupee, euros, really anything. But by getting a dual currency invoice, by looking at both of those invoices in different currencies, you can then determine, well, what is the implied exchange rate that my supplier is adding to my invoice? Because if you were to receive a foreign currency item, if you were to get a payment in euros, you would probably want to hedge a little bit. You probably want to put a little bit of a cushion and get more currency to protect yourself. And that's exactly what's highlighted here. So you can see that the implied exchange rate, by comparing the dual currency invoice, shows that the exchange rate is 6.5. Well, if you were to log into your Texas Capital FX platform, or how you would actually send Chinese renminbi, you would notice you actually get an exchange rate of 6.95. That means that $1 buys you 6.95 Chinese renminbi, which of course is a better exchange rate than the implied exchange rate that your supplier was giving. So again, comparing the US dollar amount of physically sending that amount of renminbi versus what they were going to ask you just to pay in dollars, you would look at this and say, you know what, it is more advantageous for me to send my supplier directly in currency, as opposed to sending them dollars and then having them convert it and adding that premium to protect themselves. So this is a great concept that really adds transparency to your foreign currency payments, is to ask your vendor, hey, can you please provide me an invoice with both the dollar and your local currency? That way we can compare and determine, does it make sense to start paying your vendor in foreign currency? And again, the idea at the end of the day is transparency, and to always pay in a local currency, because that is what their costs are represented in. So this next section goes into what a platform like Texas Capital's would look like to make those wire payments. So again, using the example of paying a foreign vendor in Chinese renminbi, you would log into this platform, and 24/7, 365, you can go in, log in, and set up any sort of wires, any sort of templates that would allow you to make those payments. And then any questions, we have a service number that can assist. But basically, you would simply enter the general information of your payment, your SWIFT, your BIC, transit code, anything that would be required to pay in foreign currency would be entered onto the platform. As you'll notice up here, this is the instructions for the pound for sending GBP to the UK. But for every single currency, there are different requirements. And these requirements would be auto-loaded into the platform and then asked you to complete. So just in case maybe you had a little confusion or questions between paying into peso or paying into China, this system would help you to do some of that work to show and ask your vendor what exactly is needed to make those payments. So very, very straightforward. You can save these as templates. So once you actually go and save it, then the next time all you need to do is access that template, change the amount that you're looking to send, and then wire out. Also in the system, it has a activity recap, and some platforms are not as, I'd say, easy to use as others, but here at Texas Capital, we really pride ourselves in ensuring that our platforms, our technology are top notch. So if you want to search to see what are all the wires I've ever sent to Mexico or to Europe, you have the ability to search that currency, the transaction date, or any other beneficiaries that you may need. So all of those payment details are going to be warehoused and saved so that you can print Excel files to run any reports that may be needed as you get into audit or even budgeting and planning season heading into the next year. So that was more on the wire side. Now I want to get a little more into the strategic end. Obviously, when it comes to foreign exchange, and this is beyond just the wire aspect, but let's say that you're a company that wants to receive euros, for example. Well, how do you go about doing that? So we have a client that may receive euros, and we actually can assist with accepting those euros or that currency on your behalf. You don't need to have a foreign currency account to take payment of foreign currency. And that goes the same way for making a foreign currency payment. You do not need to have a foreign currency account to make a foreign currency payment. All you would need is a dollar account with Texas Capital, and we can assist to either make or receive any foreign currency that your business may arise. So I want to dig a little bit now into the idea of hedging. So why do companies want to look at hedging? And number one, zoom out a little bit. The idea is down here. You have volatility that can occur. You have all the movement of the currency. So what this top right is showing is over a 3-month historical, so looking back 10 years, what is the 3-month historical movement of the euro? On average, it's about 2.3%. But there are certain times, like during the European sovereign debt crisis, that we saw the euro moving about 10% during a period of time that saw extended volatility due to concerns about what European debt could do for the various countries between the North and the South. So your Greece's versus your France had much different credit profiles, which then resulted in cross-border issues of, was the euro going to break up? So as we saw there, we hit near 1-to-1 or parity, where there was concern of if the euro was going to split. And then again, more recently, we saw the euro go to about 1-to-1, which is the lowest it's been in a very, very long time. And this all goes to show that, let's say that you are someone that has euro receipts, you do business over in Europe. It's great when the euro's at 130 and you're selling your goods, but when you lose almost 10 to 15% in currency, you could be selling the exact same amount of goods, but results in a much different dollar equivalent that hits your bottom line. And therefore, you could sell 1 million widgets month over month, but have a 15% reduction in your earnings simply due to volatility of FX. So here, why do companies hedge? Companies hedge to reduce volatility. You don't hedge to try to gain the market. You're not trying to win. Think about it like insurance. When you pay for fire insurance, you don't kick yourself that your plant didn't burn down because you didn't use your insurance. The idea here is to have reduction in volatility to reduce the potential for unforeseen and unforecastable problems impacting your overall bottom line and business. So finally, I want to talk about what products and how they work. So number one, typically we see clients using a forward, and all a forward hedge does is lock in the current exchange rate to actually transfer funds, plus what are referred to as forward points. Forward points are basically what are the future value of getting the currency in 1 month, 3 months, 6 months from now. But note that the forward has something to do with where you think the currency may go. It's not a prediction, it's on a forecast. It simply says on this right side, if you were to put euros into a bank account in Europe and earn interest, you were to put dollars into a bank account in the US and earn interest, where would that value then end up? So in this case, with the U.S. rates about, call it 5, euro rates just under 4, that differential, call it 1.6%. We multiply that 1.6% to give us what the forward adjustment would be to lock in. So as you can see, when rates were pretty much flat all through COVID, the exchange rate, the difference between the two was fairly consistent. But then as you saw the Fed start hiking rates, as you saw the ECB start hiking rates, you saw that volatility and the difference between the two. So what this kind of bears out is that the way that you can lock in exchange rates can change over time. But the thing that will never be different is the relationship between your spot, i.e., to actually physically exchange the currency, and then the forward point differential between those two. So I want to pause there. I do want to have a majority of our time spent for question and answer. I'm happy to go back to any more of the slides, but really the goal is to give a little taste. But then I think answering questions can really get us a long way. So Andrew, I'll give it back to you if you want to start asking some questions.
Yeah, thanks, Nick. You really efficient going through those slides. So for folks on the webinar, on the call, the Zoom, that don't have as much experience, some of this sounds a little intimidating. Like, how hard is it really? For example, when they're talking about the spot rate, swap rate, forward rate, I mean, it sounds, I know it's more, to me, it's less intimidating than it sounds, less intimidating, not more. But if someone was looking at that for the first time, how would you how would you help them out? How would you walk them through it?
Yeah, certainly. I mean, the best thing to do with any problem is to start with the simplest components. So again, the spot rate is simply the market rate. That is just where the currency is if you wanted to receive it tomorrow or the next day. We call it the cash exchange. So that's the first piece that we would use to calculate the forward rate. The next piece is then what is this forward point? What is the differential between US interest rates and European interest rates? Because again, at the end of the day, it's not to do where we think the currency will go 1 year from now. It is simply, if you were to lock in the deposit yield between two countries, that is what the exchange you're locking in from a year for now. So I think the best way to break down any problem is look at it from its simplest components and then going from there. So again, just those two pieces of information is how we would lock in the rate for our client. And note that with FX, it's infinitesimally deductible. So therefore, if you want to do one for a 6-day forward or a 1 month forward, it's divisible infinitesimally. So just because maybe you have a good that needs to be locked in 15 days out, 16 days out, a month, you can do however you need to do it. There are no like with commodities, sometimes there are specific contracts that are on a certain month end date. With derivatives, and especially in the foreign currency market, it can be customized to fit your goals and the dates that you need.
Yeah, so when we think of it, and it is the perfect analogy, is as insurance, what I excuse me, what I like about it is I'm locking in my insurance cost now, because insurance in general of all kinds, it seems to be going up quite, in double digits for the last couple of years. And we've been living in an environment, right, with Federal Reserve Bank of the United States raising rates recently, and then these eternal questions, will they raise them again and how much or not? So we're still in a sort of more variable US interest rate environment. If hypothetically, and if this question makes no sense, and Nick, you're going to educate me, but if hypothetically the Fed increased rates again this calendar year, is it likely that, I mean, the markets would adjust immediately, right? So if that happens, we will know the answer. But in general, do we see other countries' interest rates react quickly, or is it that I'd be in this situation on the US side as a US company where when I look at that swap, that example here at the bottom with the forward points, is it likely that the
Yeah,
US rate?
I think that's a great question. That's kind of borne out by this black line that is the U.S. rates. You'll
Okay,
notice that
great.
the rates in the U.S. are going up. I'll try to zoom in a little bit to see if I can.
Okay, that is the answer to the question. Yeah.
So I'm gonna try to zoom in a little bit at the bottom. So as you can see, rates in the U.S. started to go up before Europe started hiking rates, and typically as the Fed does, so does the rest of the world. They are really seen as more or less the leader in business cycles for what they will do with interest rates. So in this case, the Fed unfortunately believed that inflation was transitory. The Fed believed it, the rest of the world believed it. Well, then the Fed said, you know what, maybe we're wrong. We need to start aggressively hiking rates. As the US started to aggressively hike rates, you saw that that Europe also did the same thing. If I had the chart here to show the UK or the Bank of Canada, Bank of Japan is a different story. But if I were to put out different central banks on this chart, you would see about the same movement. As the US lifted off, other countries followed. And with that, as the US, this actually might be good to show over here, as the US let's see, as the US Fed started hiking rates, you also saw that the dollar itself got stronger and stronger and stronger until the Fed said that, okay, we're going to pause. And then you saw currencies kind of coming back up. So again, yep.
Jumping in, I did not mean to cut you off, but
No
that's
worries.
exactly because for those of us involved, and I think there's some of us on the call involved with doing business in Mexico, we saw that even in the last week or so, right? Where, if I recall, and anyone can jump in, including you, Nick, and correct me, but we've had the super peso for a while now, a very strong peso versus the USD, and therefore versus almost everything else. But in the last week or so, and pardon me, I don't recall the date, but we saw the dollar strengthen against the peso, noticeably enough that it was in the finance news, right?
Mm-hmm. So the biggest background there is, although the Fed basically said, hey, we think we're gonna pause, but then other data came out that seemed to indicate that the US economy was much stronger than anticipated. So the Fed, this was a month or two ago, said, okay, well, we're going to hike. And then they hiked. And now the question is, are they going to keep hiking or are they going to pause? So really, as the Fed talks up the interest rate markets in the US, that drives currencies around the world. So if you've been following the interest rate market over the last period of a few weeks, and that's borne out also in the housing market. So for mortgage rates, we saw that mortgage rates went above 8% for the first time since I think it was 2001. And that was driven by longer term interest rates in the US rising, as the expectation are, number one, maybe the Fed will have to stay higher for much longer. But number two, the US government is running such massive deficit that we need to continue to issue debt to pay for our deficit, to pay for the $33 trillion of debt we have. Well, what happens? Well, the average market consumer says, wait, you guys have a lot of debt. I demand more interest for that higher debt. So you have two aspects here. You have the idea that inflation may be higher, so the Fed needs to stay higher for longer. But then you have spending that is continuing to be out of control. And that is also forcing market participants to reevaluate and say, I want higher interest to hold US government debt because I know you will keep on issuing more and more debt. I need a higher coupon in order to do that. So you're having a two-way elevation right now on interest rates, and that is strengthening the US dollar, because as a country's interest rates strengthen or increase, that usually results in a likewise increase in the currency's strength versus other countries. So in Mexico's case, it was very, very strong, but then US rates started to elevate and then the peso weakened a little bit.
Hey, Nick, I gotta congratulate you. You just gave like macroeconomics 201 a couple of minutes. Yeah, that's yeah, fascinating. And you've got a future job on CNN or Fox News or somewhere, or Wall Street Journal to not be political. But so with all that being said, it's dangerous to try and predict the future. But if it appears to me, I'll speak for myself, and this is all just educational. I'm a CPA, not a investment banker or FX wizard. But uh, based on this recent experience, if exchange rate, pardon me, interest rates don't change in either nation, the United States or Mexico, the peso dollar exchange rate will stay in this range it's currently in, and we'll see if the Fed does increase
So
rates.
that's correct. If number one, if the interest rates in the US stay the same, if the interest rates in Mexico stay the same, then you'll likely see this peso range to continue. But let's say that inflation in Mexico gets a little bit higher and the Banxico needs to increase their interest rates by hiking rates, then you actually see the peso start to appreciate. But we are also in a situation where we have not had this restrictive rates globally for quite some time. So now the next question is, do we have any sort of economic issue? Do we see unemployment in Mexico start to elevate? Do we see a slowdown in Mexican GDP? If that were to happen and Banxico were to cut rates, then you would see the peso start to weaken. Vice versa in the US, if the US consumer starts to crack, if we see spending in the US go down, if we see GDP go down, then the Fed may need to reduce interest rates. And that could cause the peso to strengthen if Mexico continues to perform well. But given that Mexico is a significant trading partner with the US, any issues in the US will likely spill over to Mexico. So that's will then lead to a weaker peso. It's the idea of a flight to safety, a flight to safe harbor. Whenever you have problems globally, either economically, geopolitically, like we're seeing in Russia, in Ukraine, and now recently with Gaza and Israel, people will usually buy the dollar because they see that as a safe haven asset. So if we do see geopolitical problems continue, if people start to get nervous about risk assets, if people are concerned about the economy here in the US or globally, you'll likely see flows continue into the US dollar and potentially maybe out of the peso or out of the Canadian dollar, out of the yen. So that will be the biggest thing to watch the next few months. Number one, does inflation in the US continue to drop? Number two, do we have unemployment in the US that starts to rise? We've slowly seen a little bit of a change there where less and less and less jobs are being added, kind of indicative of end of cycle behavior. So that's kind of the question becomes, do we have a breaking event? Do we have something that occurs economically, either in the US or more broadly across the globe, where the Fed says we need to cut rates, other central banks cut rates, and then you have contagion, potential dollar strength? Or do we maintain this higher for longer, economies kind of plod along at 1% or so GDP growth like here in the US, but we have our soft landing. So if you think soft landing, currency markets should stay about where they are. If you think hard landing, expect dollar strength, peso weakness, and other countries to experience other weakness as well.
Guys, don't let me be the only, guys and gals, ladies and gentlemen, do not let me be the only one asking questions. I'm watching the chat. So go ahead and put anything you'd like to share or ask. Okay, we've got a question. Is there a mandatory withholding on money transfers from Mexico to the US between businesses?
So that's an interesting question. Unfortunately, with my position at the bank, I can't opine on tax. Andrew, I don't know if you have any background in that.
That's from Carlos. Carlos, I'll follow up on that one after the call, since, as Nick said, the bank can't offer an opinion on the Mexican tax side of things. I'll say this from my experience. My experience as one business person who's been doing business, time flies, over 20 years in Mexico, and I'm also there often for family and other reasons. But there shouldn't be there shouldn't be. There'll be fees, right, charged by the banks, and each bank on either side. And maybe Nick, this you could talk about fees a little bit later, but the banks, of course, will have fees. Or if you're not using if you're using a non-bank bank through some kind of app, right, they may or may not have a fee. But and things can get really complicated really quickly, which is why I don't blame Nick and the bank for not wanting to jump in here. Probably need to do a separate webinar just on this. I'm going to say, generally, in my experience, when that money transfers to pay an invoice, there shouldn't be. Okay, notice what I said, right? I gave you a very specific example, and these things can change when they do suddenly and dramatically. Though this has also been fairly stable for a while.
Certainly.
I don't want to go too far on this because it really is worthy of a whole separate webinar, and I don't want to take us too far off topic. But for example, Carlos, one thing is paying an invoice and the ongoing nature of doing business. Something could be very differently if that payment was of the nature of a capital transaction or dividend, right? So very quickly, it can become complicated. But generally, if it's the nature of an expense, there should not be. And this is why I say, everybody, sincerely, you got to check with both your bank, whatever side of the border you're on, and many of you are doing business on both sides and may have legal entities on both sides and you may be working with the same bank on both sides, which will make it easier, right? That's one option. But if you are working, whatever reasons, often it's cost, with a different financial institution on each side of the border, hate to say this, talk to each of them and ask the questions, because each financial institution has their own rules. So right, so one thing the government says, then another thing is how each financial institution interprets those rules. For example, those of you that have been in international business for a while, or if you've been involved in cryptocurrency, either one, the requirements for know your customer have been getting stricter and stricter, and now they want to see your driver's license. I'm talking about here in the U.S., by the way,
Certainly.
Mexico. So you have to stay on top of it. Always ask the questions. If you can work with the same financial institution on both sides of the border, obviously that will facilitate it. That's not always the best option, though. Ask the questions, and also, Carlos, great question. And I'll get back to you offline. This sounds like it's worthy of its own webinar, but I don't want to even take time and next time. But
no, got it. Thank you, Andrew, and thank you, Nick.
Of course, and another aspect too is intermediary banks can sometimes take fees, if you will. So if you ever send a wire and there's that $15 or $30 whatnot fee that comes out, that can also unfortunately impact invoice payments. So this is another reason why typically sending a foreign currency wire to a local beneficiary can be beneficial, because they'll receive the payment in full, as opposed to if you were to send dollars. Not only is there a potential exchange rate impact, there could also be a fee that then further complicates things. So we typically advise that.
That's a really good point. I mean, I can tell you with the super peso, a lot of feedback I got from Mexican business people was they were enjoying but they perceived, again, it's exchange rates change over time. So right, so it's like the weather. Where are you that particular day? But they were enjoying it and still are. But from point very well said. To keep it also helps keep your accounting nice and neat, right? I got an invoice for 100,000 pesos. I paid 100,000 pesos. We're done.
Mm-hmm. Exactly. Any more questions on your end, Andrew?
No, I'm going to jump in with another one since the folks are giving me the chance, and we'll wrap up soon, guys. I know it's already almost 12:40. This has been fun. But you mentioned the word contagion. That's a scary word. Maybe you want to just give us, what does that mean in your as it relates to foreign exchange and international treasury?
Yeah, certainly. So back in 07, 08, obviously we had the global financial crisis, and China was the engine of growth that was able to kind of pull the rest of the world out of a really chaos that was occurring, a lot of contagion either between banks and countries and counterparties. But the strength of the Chinese economy was able to really help the world by being a producer consumer for that. Well, now we're seeing China's having their own problems when it comes to demographic cliffs. So the one-child policy has led to a significant upside down pyramid, like we're seeing here in the West, when it comes to too many older generation, not enough young to support their retirement. China is seeing a massive problem with that. So their property sector is the biggest kind of symptom of that. You can only build so many houses and condos and apartments, but if there's no next generation to buy it, then you of course have this kind of accordion compression that's going on. So the question of whether or not Chinese growth can continue to be the engine as, for example, the UK and Europe begin to tip into recession, can that be a problem? Fortunately, again, here in the US, things seem to be going pretty good. I mean, it depends on what data you look at between the consumer that has all-time credit card debt. They've basically depleted all their savings. So the question is, how much longer can this continue? But for now, it does appear that the U.S. is doing relatively well compared to the rest of the world. So do we have a situation again where the U.S. has more of a soft landing? Maybe Europe, UK has more of a hard landing recession. But again, in a globally connected economy with oil prices surging based on the potential conflagration in the Middle East, is there an event that tips us from soft to potential recession? So as with anything, we're in a very, very volatile time period. So talking to Andrew as an advisor or reaching out to banking partners is a great way to get through any sort of chaotic environment. The more people you can have on your side talking to you, giving different ideas about your business, about how to get through this potential cycle, I think the better. So although contagion is not something that you can control, hopefully volatility or partnership is something that can help to weather the storm if one does potentially come in the winter.
Well, very well said, Nick. I'm going to jump in again. So it is, I hate the expression, it's so relative, but if one thing is, if there's one place where that's absolutely true, it's exchange rates, right? It's the relative value of those, the value, strength, various words we use of those two currencies against each other. You know, another expression I'm not the biggest fan of is this time it's different, but you brought up China and what we're seeing in Mexico. And as you said, of course, there was just an event here at SMU in Dallas last week at the Texas Mexico Center. And based on their data, which is driven by US federal government and Mexican federal government data, Mexico has replaced China as the largest trading partner. With certainly it has been for a long time with the state of Texas. Where am I going with this is, yeah, the US and Mexico, the Mexican and US economies are almost Siamese twins, though not twins in size, in the sense of size, obviously, but they're joined at the hip. Why it might be different this time is there are billions of dollars, I mean, B with a B, going into Mexico, whether you think of it as nearshoring, offshoring, reshoring, friendshoring. I just saw this weekend, as manufacturers are, diversifying their risk from being basically China only, taking advantage of the now USMCA, previously NAFTA, and it's just mind blowing the amount of business and investment, foreign direct investment going into Mexico. We'll see. I mean, obviously it is all driven by the ultimately US market. I'm sort of thinking it might be a little bit different this time just because these are long-term, right, capital movements from China into Mexico, because even if we have a rough landing and a strong recession here in the US, which would lead to one in Mexico, no doubt, but hopefully of a lesser extent than in the past for Mexico, because these, think of a production line, right? They're built to operate for what, at least 3 years, more typically, 5 to 6 or 7 to 8, depending. So it's interesting. That's for sure.
Yeah, I think that the concept you're getting at is the fortress North America,
Yes,
where
I love.
we would have you'd have oil and gas from Canada, U.S., Mexico. You'd have manufacturing in the U.S., Mexico, and Canada. It's basically kind of really creating a delinkage of the rest of the world. I mean, that can never happen, but at least to try to build some strength back here so that we are less dependent upon contagion from other parts of the world spilling back onto the US.
Yeah. And you mentioned unemployment in Mexico earlier. Again, driven by everything we've been discussing. Skilled and even skilled and we need a new term for something that's not really unskilled but not really skilled labor. So like skilled but skilled enough that you can be
Semi-skilled.
Yeah, semi-skilled. We have to use that. We needed that term because to work in a modern any kind of modern manufacturing, you don't necessarily need to be highly skilled, but you have to be semi-skilled. And there's already a shortage of that labor in Mexico and any of the heavy industrialized areas, predominantly on the border, but not only the border. But I know we're hitting 12:45. Any more questions, folks? Because I love them. I love the questions. They get me thinking differently as well.
Yeah, Nick, any thoughts on Argentina these days? I mean, especially as with currency restrictions and currency, they have at least two types of FX and hard to buy dollars and remit dollars to the US. Any general thoughts on that?
Yeah, Argentina has just been a very, very difficult one. You have the official exchange rate, as you mentioned, and the black market exchange rate, as you're alluding to, the capital controls to get money out of the country. I mean, they're experiencing hyperinflation. That is it's a very difficult story because once you kind of start on that spiral, it's very, very, very difficult to stop it. I don't foresee any near-term potential to have it get better. It needs to have a lot of institutional and just capital cleanup on its end. And it's great to do business down there, but it's very, very hard to do business down there. And have dealt with a lot of clients over the years that have made good investments, good return, but getting capital out of the country is near impossible. So I don't have a great answer for you, but the hope is that, again, nearshoring, friendshoring, that idea that building more manufacturing closer to Mexico and the US, is there a potential for that to turn around? And as we've seen it in Colombia has benefited from that. So it remains to be seen, but they have a lot of structural problems that over the years have been very difficult to solve.
Great. Thank you.
Yeah. The Argentinian Chamber of Commerce, their Texas chapter is pretty active. You could touch base with them. I was going to ask both of you, what Argentina is just a amazing country, a fascinating macroeconomic case study. But I sort of feel like we've been here before with Argentina in this sense. Is there anything we can learn from previous administrations in Argentina and how they've tried to manage, for lack of a better word, their currency?
It always seems like the next best thing is around the corner and they're going to solve it. And then, like most politicians, not the case. So hopefully someone raises their hand and thinks they can fix it, and then they actually do. But it's hard.
I'd say for everybody on the webinar, they just had the presidential elections there, didn't they? So we'll have, maybe that's the spark that ignites a solution for this.
Certainly remains to be seen, but I mean, you can always be cautiously optimistic, but it's just such a deep hole to dig out of that it will take a generational change to get that done.
Yeah, I mean, it's an amazing country, but yeah, we'll have to wait and see. I'm going to hope for the best with the election they just had, and but certainly we'll see. Great question. Hey, that was a fantastic question. Thank you. Well, folks, are there any more questions? If not, we're at 12:50 and everyone's got to get back to their clients and work, etc. Hey, Nick, this was great.
Yeah, certainly. And I have my contact information on this slide as well. So if anybody wants to reach out, please don't hesitate to discuss. I'm happy to, like, again, we have a significant amount of capabilities at the bank, everything from simple dollar bank accounts, credit cards, but all the way to our investment bank, which I'm a part of. So loans, ABL, capital markets opportunities. So if there's anything that we can do to assist, please don't hesitate to reach out. I'm happy to be a resource and get any connectivity that I can.
Hey, thank you again. Thank you, Nick. You've got his contact info. You've got his LinkedIn page there in the chat. Of course, everyone, if I'm always happy if anyone finds it, whatever reason, it's just easier to shoot me an email or a message. Happy to connect you all with Nick and connect you with each other. Hey, this was great. You took a pretty, that's a pretty hard topic, right? In the sense that little hard.
It's never boring, put it that way.
Yeah, I was trying not to say, but yeah, you turned it into a really nice discussion of the realities of the current, macroeconomic situations. Hey, thank you so much, Nick. Thank you for the questions. Thank you everyone for joining. We'll have to have Nick back next year, give us an update perhaps.
Of course.
And thank you, everyone.
Have a great day. Thanks so much for everyone's time.
Appreciate
Thanks.
you all.
Bye.
Thank you.